Hello everyone, and welcome back to another market review. This is Silent. Today we're looking at the NASDAQ December contract for 2025. We're starting off with the weekly chart here. So I've left the weekly buy-side imbalance on the chart. And I've moved the measurement from the gallo that we were measuring last week to get the high of Friday, and I've moved it to this weekly wick consummate encroachment. So simply taking a fib from the low to the high and measuring 50% of that wick there. If you remember, price rallied up and then sold off last Friday and into this higher time frame weekly level. Today we gapped up from last Friday's closing price all the way up here, which is above the lower quadrant of this entire down close candle. So we traded lower, closed all the way down here, and then gapped up about 30% of the previous weekly range. And we've traded higher on Monday's price action and closed the day pretty strong here. I'm not going to get in the way of this delivery to constant all-time highs, but I will be utilizing the opening price of last week's candle and as much as the wick consummate encroachment here as a barometer to give me a weekly bias. So if we continue tomorrow up through the previous week's opening price, my first expectation would be that 197 level, and if we can find any support within this range, we might as well try and put in a new all-time high. If we find weakness after tagging the opening price here or just simply gapping down from the overnight, my expectation would be that the upside delivery so far this week is just simply putting in a wick on the higher time frame candle, and if we begin drawing lower and trade back below the opening price of the week, I'm going to be bearish for the rest of the week and then begin expecting price to draw down into these sell side liquidity here under these candle bodies lows and down as far as 556, and then beyond that we'll have to talk about it when we get there. So again, utilizing the opening price, if we see sensitivity as a premium objective, let's look bearish. But if we begin pushing above the previous weekly open, let's start targeting the 197 going into tomorrow. On the daily time frame, we are still referencing those higher time frame levels. After we've extended them through, we closed just above that old daily high on last Friday and then gapped up all the way above this lower daily buy-side imbalance. And then as we got through the low of this purple shaded imbalance here, we traded right up through that and started making our way up higher. I was watching this candle last night and it rallied to the high of that, which is the low of our daily buy-side imbalance here. Again, depending on the open, I'll be looking to see this area produce a sell-off. So we'll have more information as we go into midnight tonight. I'm not keeping a hardline bias in either direction. I'm just simply outlining some levels ahead of time and utilizing them as barometers for higher or lower as we reach them and trade around them. Nothing to add to the chart currently. All we've done is gap up and trade into an old imbalance here. There's nothing new that we referenced from the previous week's price action that it's tagged up into besides this low from the 3rd of October. You could extend that out in time and measure the sensitivity off of this range if you would like. It's better to not stick to one side. Take small scalps intraday as higher time frame ranges and models set up a new higher time frame high or low. We will be able to determine the next swing from that. On the 4-hour time frame, all I've done was simply bring down our higher time frame daily and weekly levels to this chart, and I've added this large 4-hour buy-side imbalance here, and I've removed this old level from this candle just to make the chart a little bit cleaner and more focused on what we're currently looking at. Again, after this drop down on Friday, we gapped up, and this 4-hour candle in the overnight produced a buy-side imbalance as we rallied away from the lows there. And we consolidated for a few hours here, and price begins dipping down into this imbalance while staying above the low of that old 4-hour level with the bodies. So only wicks have been able to drop down into this range. Again, we'll be utilizing this 4-hour buy-side imbalance as a barometer going into tomorrow. Until we leave this 4-hour range or the higher time frame daily imbalance range, I'm not going to suspect a breakout is ready in either direction. So as we open in Asia, if we're inside this range, my first expectation is to have a range bound delivery from the daily buy-side imbalance high to the low of this 4-hour imbalance. And as far as this gap is concerned, if we begin trading back below it, I'll be utilizing it as an inversion array and expecting bearish price action to deliver from that level and send price lower. So say we do end up being bearish tomorrow, if we consolidate here in the overnight and then begin breaking outside of this 4-hour imbalance, I'll be waiting for this lower imbalance here to be overlapped and start being treated as a premium array for me to confirm that this is going to be a bearish move. If it is bullish, I would not want any return back down into this range because we've already done our objective of dipping down into that range twice and trading higher. So if it is going to be bullish, we're going to want to see some strength from this range. So after consolidating, we would want to see price begin pushing up and utilizing the high to the midpoint of this range as discount sensitivity. As we continue to drop into lower time frames, it'll be quite evident as to why we should be waiting for price to make it obvious for an underlying direction. Obviously, we went down a lot on Friday, and so price is going to need to take some time in digesting that move in order to create a structure that makes sense for us to trade and allow the market to build sentiment and create liquidity on either end of a range. So after we dropped on Friday, we rallied back up in the overnight and then started midnight right around the equilibrium of this downswing range. And price has had a hard time extending outside of that. We spent all day at the equilibrium price point of this downswing here and just consolidated. So the first thing that should be in your mind after seeing such a large extrapolation in one direction is a return to equilibrium and then consolidation. Anytime we have such a large move, you're going to want to be standing on the sidelines of that and allow price to digest what just happened and allow for early traders to get caught up in the hype of what happened on Friday and give up a lot of their money that they may have profited on this down move during this consolidation. So after price digests what happened on Friday and is able to break outside of this consolidation range, after purging liquidity in the opposite direction, we'll have a lot more reference points to determine a bias that is higher probability. So again, say we start consolidating here overnight and then price doesn't really leave from this range, but as we go into London or New York, and say we start running out buy-side liquidity and then pulling back inside this range, if we start running up first and then show evidence of a downside right afterwards and no imbalances as we leave this range, I'm going to begin fading that and expecting a strong downside extrapolation back into the new week opening gap. So if we consolidate, run up either in New York or London, and then break back into this existing range with a fair value gap, I'll be utilizing that fair value gap as a selling opportunity. To cancel that out, breaking outside of this range with an imbalance that is supported as a discount array and a rally from that range, our expectation would be these highs here. Personally, I'm favoring more downside, so I'm looking for the first scenario to happen, a rally up and then drop lower. But it's going to be low probability until one of those things happen. On the 15-minute time frame, you can see just how consolidated price was today and how difficult it would have been. We closed lower on that Friday and gap up a significant amount. Price trades up in the overnight and then begins consolidating. Every time we rally up above old high, we pull right back into the range, or anytime we drop down into a low, we pull right back into that range. And it's ignoring the bearish and the bullish arrays that should support price if it was going to be a breakout. Just like we spoke about on the hourly chart, you can see how price attempted a breakout and left a fair value gap here and here, but it was overlapped quickly and price had no willingness to trade above it. It just turned into consolidation. And the same way, after we dropped down and left this fair value gap, it began referencing it again and had no interest in selling off from this range, and it began consolidating. These are the hallmarks of a consolidation. It's just simply creating an extreme of a range and then pulling back into it and overlapping the most recent bullish or bearish PD arrays that should have been utilized to continue its downside, but it doesn't. It cancels it out after we consolidate for so long and then trade up higher, or consolidate for so long and then trade lower through it again. So this kind of price action is what I will be expecting until a significant move like this is produced with a gap and it's treated as a discount or as a premium array on the downside. On the 5-minute chart, again, you can just see how sloppy that price action is. It's definitely not untradable, but it's not something that is easy to trade or is something that you should feel comfortable trading all the time. These conditions are better to just avoid and look back at in hindsight and be thankful you didn't get trapped up in all of this back and forth action and potentially do harm to yourself. Days like this, I used to go in and give a lot of the profits back from the week just before, because as you drop down into lower and lower time frames, the moves do look enticing, but without an underlying expectation of the day, you can easily be falling into traps that can catch you off guard. Say if you were short from here and didn't take all of your profits down as we dipped into this range, if you didn't have an expectation of a consolidation day, you would be not taking all of your profits off at this range low and potentially see your trade get ran back on top of and stop you out. And so these days are definitely good for learning experiences or practicing. It would build your experience by paper trading or demo trading these conditions, because you will start to develop a subconscious expectation of what price should and should not do. When price is constantly going against you after running a small bit, you'll quickly learn what price should not be doing in your underlying trades. If they were going to be continuations, this should not happen, for example. So it should have sold off, but it rallied above instead, and it didn't drop afterwards. So this kind of drop here and failure to sell off anymore would be something that is beneficial for your experience, because the more time that you engage in low probability environments, the more conditioning you will have built upon yourself in order to avoid days like this. And you'll many times place a trade on and then get these characteristics like this, and it'll be an early enough warning sign for you to get out and just step away from the day instead of falling into a continuous trap of falling in love with a direction or a price target that never gets met. These conditions are definitely not one that you would be trading to make lots of equity. These conditions are more for learning what price should not do. If this was a low resistance liquidity run environment, these characteristics after this drop off, all of this is not something that should have happened. On the 1 minute chart, I've done nothing but bring down our higher time frame levels, and I've added the first presentation fair value gap from the AM session and the PM session. And you can see already that based on the amount of times that's been traded up and down through the range, it's already indicating to you that price may not be the best to continue trading this day, or it's better to just step back and scalp only. There's many scalps that you could have completed off of this level alone, but the fact that price utilizes it, runs away from the level, and then it comes right back, it's not something that you would see on a classic trending day. And the simple fact that price returns to it so much is a early indicator that price is in a low probability environment. So even if you did not have an underlying expectation of low probability going into the day, you can use a level like this as a gauge for your market sentiment. And if price continually refers back to this first presentation, more likely than not, it's going to be low probability. But if we trade into it and away from it just 1 or 2 times during that morning session, we're most likely going to be in a trending environment. The same can be said for the afternoon session. As you can see, we opened up with a bullish imbalance on the PM session first presentation fair value gap, and price did not revisit this level before rallying up and taking out the buy side liquidity here. So again, if you remember from previous videos, gaps like this that are not traded into on its initial accumulation are usually targets later on in the day, especially first presentation fair value gap. And you can see how price does a turning point here, sells off from this fair value gap, and drops down into that opening range imbalance. We dip down below it a couple of times there. Every time we trade back up into this range, it gives a sell-off, but it's not sustained. As we dip under these lows from the opening of the PM session, we consolidate and then rally right back up and close above the PM opening range imbalance. We consolidate again, drop down to the low of that range, and then rally. And then every time we rally up a little bit, price drops back down towards that first presentation fair value gap. Everything in here is signaling to you to step back and let price do its thing and just come back tomorrow. Alright guys, so that's going to be it for me today. If you found anything insightful, please let me know in the comments. And as always, don't forget to like and subscribe. I'll see you all tomorrow.